All right, we have Neal Bawa here with Grow Capitus. He's the founder and CEO, commercial real estate investment company. He sources, negotiates, and acquires commercial properties across the United States for over 230 investors. His current portfolio includes over 1,500 units with multifamily and student housing properties in 7 states. He is also the CEO of Multifamily U, an apartment investing education company. Neal, welcome to our Multifamily Investor Nation Summit. Glad to have you here.
Thank you. I'm glad to be back on this event. You put together an incredible audience every time we do this. And being a multifamily guy, I presented a lot of events, but it's wonderful to have an audience that is very interested in multifamily. Now, having said that, I'm going to start with a disclaimer. Everything you're about to watch is not specific to multifamily. Everything that you're going to see works just as well for single family, a duplex, or a quadplex as it does for multifamily. But as you can imagine, I use this constantly, 5, 6 times a day. I use the principles I'm about to teach you, and I do use them for large multifamily for sourcing my properties.
Well, I know I'm excited about listening to this episode, this session. I've heard it, I think maybe once or twice. And you always change it up and change things a little bit, which is what I like as well. And for those of you who are participating and watching, I want this to be as interactive as possible. So I'll have him get through the material as much as he can. And towards the end, we will have plenty of time for questions and answers and different things like that. So Neal, take it away.
Fantastic. Well, once again, my name is Neal Bawa, and let me start by telling you that unlike a bunch of people that are in this virtual summit, I'm very far from real estate royalty. I haven't flipped 100 homes. I haven't done 1,000 loans. I'm a technologist, a core technologist, a data scientist that fell into real estate accidentally through my day job. My company was doing really well, and we didn't want to rent, so we started building campuses, and I was given the job as the chief operations officer of the company to build these campuses from scratch. And so it was trial by fire. I built the first one in 9 months, beginning to end, basically from, not even having construction drawings to having certificate of occupancy in 9 months. And I think I might have slept for 9 hours in those 9 months. It was just insanity. And at that point, I was incredibly stressed. And I was basically constantly bitching and moaning and complaining to my CEO about the fact that I have to run a 400-person company during the day and basically work on this stuff during the night. Why would he have me involved in this whole process? Why couldn't he just hire somebody to do it? And now I cannot thank him enough, because what I learned there was absolutely astonishing. New construction skills are very hard to find. Even in the syndication business, most people don't know how to do them. And so I built one campus, and it was 27,000 square feet. And it was such an accelerator for my company that 2 years later, I had to build a second campus. And this time didn't have enough money. It was a larger campus, more expensive building, $9 million. And so I learned how to syndicate. What's funny is I did a successful syndication in 2005 or 2006, I think, without ever realizing I did one. I probably broke every SEC law in existence because I simply didn't know what the word syndication was, or that there was even such a word that existed. I was simply telling a bunch of rich doctors in Fremont, I'm buying this building and I'm going to buy, 10,000 square feet of it for my use immediately. And I want to chop up the rest of the building into 2,000 square feet condominiums and sell shares to you and then rent it back from you as a tenant for my business. And when I made the pitch, I thought nobody would listen to me. I thought, like, why in God's name are these rich doctors going to give me money? And then in 50 minutes, I walked out essentially with the entire project sold. And that was the first time I realized the power of real estate and how much people, believe in it, how much people believe in what real estate represents to their life and to their financial freedom. And so I did that project. I ended up buying one of the suites from one of the doctors that was short on money. And I absolutely adored the depreciation benefits. As you can imagine, I had a big fat tech salary. So I was paying, in Taxifornia, I was paying, 45% taxes every year, including state and federal. And so all of a sudden, my taxes went down because I had this, 2,000 square foot suite with massive amounts of depreciation. I was like, wow, this is really cool, right? So I started buying more real estate, single family. I've bought 10 in California. I've bought 10 triplexes in Chicago. I've built in Seattle, 6 townhomes in Seattle. So I got involved into it while I was still running my technology business, which was sold in 2013. But this is not a good story. This is a bad story. This is a sad story because for me, before real estate got good, it got really, really bad. You know, what I learned was when I stepped into real estate on a full-time basis is that real estate is not all good. It's the home of, you know, false promises. It's the pinnacle of exaggeration. It's, you know, the mecca of bullshit, right? I come from a background of engineering and data science where we're taught that data is the foundation of everything that you do. And I found that in real estate, data was not the foundation of anything. What it was it was being used to gloss over low returns or sugarcoat tall tales. And I unfortunately fell into that trap myself. I sugarcoated. I told tall trails. Tales. I shoveled bullshit, and my investors suffered. And I couldn't sleep. I had an entire year where I would just lie awake at night staring at the ceiling because one of my projects didn't do well. And during those nights, uncomfortable nights of just self introspection, I realized that the right path was the one that I had started with. The right path was the one that I have years of professional training in. And that is the path of hardcore data science, you know, basically the use of analytics to do anything in real estate. And so I pivoted, I made a change. I started saying no to far more projects than I said yes to. And once I pivoted, my life changed in real estate. So that has brought me to where I am today. My portfolios, as of next week, goes up over $200 million. I have over 1,200 investors registered with me. 1,000 of them are accredited. Over 400 have already invested with me. By the end of this year, that number is going to go up above 700. But none of those statistics matter. What matters is that this year I'm going to give millions of dollars of cash flow to my investors. And that, I think, is the only true sign of success. And it came from data science, and it came from this presentation. Everything I'm about to teach you, I do every day, right? So this is not something that I created so that I could basically give it to a bunch of people to impress them. But this is stuff that I do every single day, and it's incredibly powerful. My dad used to say, if there is a God, he must be in the numbers. And I've always believed that. I've always believed that if God exists, he's the greatest mathematician of all, because the world has rules, and those rules can be used to basically game the system legally in your favor in 1,000 different ways. I teach a boot camp. Hundreds of students take it every year. It's a multifamily technology-driven syndication boot camp. And I teach about 55 different strategies in it on how you can game the system to your advantage. The most powerful of those 55 strategies is what I'm going to teach today. Best cities and neighborhoods in the US to invest in. This is a workshop. There is no PowerPoint. I hate PowerPoint. I'm going to basically give you a set of demos. You can follow along on these demos. You do not have to write anything down because at the end of the presentation, I'm going to give you a toolkit that I use every single day. It has the rules and it has an Excel spreadsheet. So you don't need to write down, just follow along as we get started on this journey. So I hope all of you are ready, and I hope Dan is ready. Dan, are you ready for a journey into planet data? Oh, he's busy checking his Facebook. So I'm going to get started here. All right. So as I spent time understanding the mistakes that I'd made in that one property that I was telling you about, and then some others, which I also made mistakes in, what I found was that you can create a hypothesis about what's a good city to invest in and what's a bad city to invest in. And you can apply that hypothesis to 10 or 100 or 1,000 cities or states, and then back test it to see if your hypothesis worked. So over time, I created a total, and I'm going to click on the chat here so I can actually see what people are saying. Over time, what I did was I created a set of hypotheses, and these are 10 hypotheses. I call them real focuses. Now keep in mind, and I hope you can see my screen here. I want to make sure you can see my screen. Let me click share and main screen and share. There, that should definitely bring the screen up. Perfect. So 10 different hypotheses, and 5 of these are best city hypotheses, and 5 of them are best neighborhood hypotheses. And let's start going through them. My first hypothesis is that what you do not want to invest in a city that does not have population growth. So there's some good cities in America that currently do not grow in population. Um, the best one that I can give you is Cincinnati. So if you look at, last 150 years, it's been one of the biggest metros in the US. Another one's Philadelphia. Cleveland is another example of a city that does not grow. My hypothesis is, if you want to be a successful real estate investor, focus on cities that have population growth. And not just any amount of population growth, there's a minimum benchmark of population growth. If you go into those cities, you will get faster returns. You will see greater appreciation. You will see greater rent growth. So how much appreciation? Real Focus One says that if the city is between 250,000 and 1 million in population, which, by the way, is the vast majority of cities in the US, right? So I'm going to turn this off here. My staff keeps trying to reach me on Slack, so let me quit Slack. So vast majority of investable cities in the US are between 250,000 and 1 million. For those cities, you want this much, 20% population growth between the year 2000 and the year 2017. And I know we're in 2019, the rule still applies. Cities, their population trends take decades to change. And so if your city's trend between 2000 and 2017 was X, it's going to be most likely, the vast majority of the time, still going to be X for another decade or two before it changes. So it's okay to use 2017 data. If you want to buy data, and I'll give you a source for paid data, you can get 2018 data. At this point, you can get 2019 data, but I assure you, you're going to be wasting your money. The free data that I'm going to show you works just fine. Now, in each of my real focuses, you'll notice that in the Word doc that I'm going to give you, there's also scenarios for larger cities, scenarios for smaller cities, scenarios for how do you use my system next year? How much growth do you add to this 20% number next year? Well, this much for this particular real focus. So I'm not going to mention those in my presentation because Evil Dan only gave me 75 minutes, but the rules are all there. But I can tell you the vast majority of cities in the US are going to meet the 20% rule. So let's actually see this in action. 20%. Let's take a look at it for some cities in the US. So first, I'm going to take a look at it for cities that I don't believe you should be investing in. Wow, look at that. Multifamily Investor Summit came up. So let's take a look at the city of Detroit, Michigan, right? A ton of you have heard that Detroit, Michigan is turning around, that Detroit is turning around. And I want you to look at this graph and look at that blue bar that's on the screen. And please point out one point on anywhere in any year on this blue bar, one point where Detroit stopped losing population. It hasn't happened. All that has happened is the rate at which Detroit loses population has slightly slowed. I can tell you when you invest in a place like Detroit for buy and hold, you are not an investor. You have to be honest to yourself and say, I am a speculator. I am betting that like Bitcoin turning around from 4,000 to 13,000, the city of Detroit is also going to turn around. But the truth is the vast majority of cities that lose population for a very long time. And you could win when you're going into that city, but you're going to lose when you sell 5 or 10 years from now. So how long has Detroit's decline been? Well, Detroit happened to be the second largest city in America in the year 1959. And you see this number here. In 1990, it was 1 million people. Well, it was 1.6 million in 1959. And Detroit's population has now been dropping for 55 years. And everybody that tells you that Detroit is turning around is not a numbers-driven and analytics person. A city cannot turn around until its population starts to grow, not just plateau. It needs to grow. And you might say, but Neal, all of the places where population is growing are going to be far too expensive for me to invest. There's no cash flow. Well, that's not true. That's not true because in the Rust Belt of the United States, in the Midwest, is another city. It's Columbus. It's in Ohio. Take a look at this particular city's blue graph. At no point since 1990 has Columbus lost population or had slow population growth. This is very, very strong growth. And notice very carefully, I want you to look at this blue bar, stare at it. You'll notice that there's 3 different growth rates. The first one's right here, then the second one's right here, and then a slight bump up, an acceleration that started in the year 2010, just as we started coming out of the recession. And now this is the sharpest. So here's a city that is in the Rust Belt, in a state that doesn't gain any population. Ohio's population is pretty flat. And most of the other cities, you notice the one that's green and the one that's orange, are actually losing population. Cincinnati's losing population. Cleveland's losing population. Dayton, Ohio is losing massive amounts of population. Where do you think those people are going? They are going to Columbus. And that's the beauty of looking at this method. You can game the system by looking at where the flows are of people leaving a city that doesn't have enough jobs and moving to a city that has a lot more jobs. And that's why population is growing up in Columbus, because its job growth is so much higher than anywhere else in the state of Ohio. And it's a Rust Belt city. And in about 5 minutes, I'm going to prove to you that it is a city that you can invest in for a reasonable amount of money. All right, but before that, let's take a look at Real Focus number 2. Real Focus 1 talked about population growth, and you want there to be 20% population growth, right? 20%. Well, did Columbus actually meet that criteria, and how do you know that? Well, let's go back to this page. So today, Columbus's population is 879, right, in 2017. Move the mouse back, left, 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 left. And right here, 2000, it's 714,000 people. So you got two numbers. Where do you plug them in? Well, of course, I've given you an Excel spreadsheet. You'll get that at the end of this presentation. So I've already plugged in the base numbers for Columbus here, 715 in 2000, and in 2017, 879, boom. Columbus has grown by 23% in that time frame. So it more than meets the 20% benchmark, which is Real Focus 1. Let's try Real Focus 2. Let's see if Columbus meets Real Focus 2. What does Real Focus 2 say? It says that if you go into a city where population is growing, its median household income will grow even faster. So with a city that has 20% population growth, you can actually get 30% median household income growth. Now, you notice something's odd, because in the last one, I showed you that you're comparing 2000 with 2017. But here, you're comparing 2000 with 2016. And you go, wait a minute, Neal, why 2016? Well, the answer is because Google doesn't really give us median household income data easily. So I'm using a different website. It's called city-data.com. And city-data.com has not yet updated to 2017. Once again, income growth changes over decades. It doesn't really change. Its trend doesn't change over 1 year, 2 years, or 5 years. So you're perfectly fine with using city data. If you want to pay for brand new data, localmarketmonitor.com. Pay $1,000, you'll get brand new data. I don't think it makes a difference. My simulations show that my conclusions were the same when I was using free city data than when I was using paid local market monitor. All right, so take a look. City-data.com. These are the 2 years you're comparing, and you want a 30% growth in median household income, right? So how do we figure this out? Well, we go to city data and we type in Columbus, Ohio. And I've already done that. And this is what the page looks like. So this is what the actual result page is. And all I'm going to do is scroll down. I'm going to scroll down just a teeny tiny bit. So scroll, scroll. And I'm going to get to this section here that says estimated median household income. And you notice that it's giving you two different numbers, 2016's income and 2000's income. Once again, you're going to take these two numbers and you're going to plug them into the Excel spreadsheet I give you. And notice that I've already done that for Columbus. Here's the 2000 number. Here's the 2016 number. And the growth in income was, voila, over 30%. So not only does Columbus meet Real Focus 1, it also meets Real Focus 2. So now let's go look at Real Focus 3. And Real Focus 3 says, oh, if you did a good job on picking it by population and the median household income hit this 30% number, guess what's going to happen? Well, your median house or condo value is going to start spiking. Population growth creates congestion. Congestion creates more jobs to serve that new population, which creates competition for employers, which drives up job growth, which drives up income growth. People have to pay more on salaries and wages. And when people have higher wages, guess what? They can afford more expensive housing. So Real Focus 3 says, look for 40% growth in median house or condo value between those years, 2000 and 2016, using the same exact website. So this is what you're looking for in terms of your growth as you're moving forward. Median house or condo value, 40%. And you might say, wow, that's a lot, Neal. 40% is a huge amount of growth. There are cities in the US, guys. There are cities in the US that are at 100% growth over that time. Phoenix, Orlando, Las Vegas are all over 100%. This 40% growth number is actually very low. I personally, when I'm looking to invest, look at 60%. That's what I'm after, a 60% growth number in that time frame. But where do we find this number? Where can we actually see the number? Well, back to the same page. Remember for Columbus, we'd pulled up the median household income, and you see it in front of you here? Yes? We'll just go down about an inch and a half, and you see estimated median or condo value, and you see two numbers. 140,000 now, 2016. It's gone up a bit since then. It's probably more like 150 now. And here it's 99,000, right? And so you see the difference between these two numbers. The first thing you note is, wow, so here's this interesting city. It's in the Midwest. Its cost of living is low. Inflation is low. Population growth is there. I just saw that the incomes are going up, but I can buy a single family median house for $140,000. You know what median means, right? Half the homes in the city sell for less. And most investors are buying the ones that sell for less than 140,000. They're buying 80 or 90 or $100,000 homes in Columbus. They're not buying the $250,000 homes because those are very nice homes that residents are buying, people that want to live in Columbus, not people that want to invest in Columbus. So very inexpensive, but also very profitable. As you can see, the city is going, everything seems to be going in the right direction. So is this number 40% higher than the other number? Let's figure out if it's actually higher. Well, remember that Excel spreadsheet? Let's go look at Real Focus 3. I've already plugged in the 99 number. I've already plugged in the 140 number for Columbus, and boom. As it happens, Columbus is at 42%. Now do you see how things go up? Population drives income, and income drives house value growth. And you get long-term appreciation, but you also get rental benefits. Why? Because rent growth is not tied to home value growth or population growth. It is tied to income growth. And look at how much income growth there is in Columbus, which allows you to keep raising your rents as the city's people have more and more and more money. All right, let's go back to our presentation, and I'm going to do something for a second here on my second screen. And give me a second, guys. I need to pull up another supporting document. And give me a second on that. Okay, I'm going to go pull that up in Slack. That will give you guys a few extra tips, and I want to make sure that I give those out to you guys today. Let's see, boom. All right, there we go. I'm going to move this over to the right, and let's get started again. So we covered 3 real focuses so far. And by the way, in case you're wondering, did I take these real focuses from a book? No. Did I take them from a blog? No. Was I inspired by somebody on the internet, which, you know, obviously is very common for real estate. People get inspired by what others are doing. This is hard science. And I put the time in by looking at hundreds and hundreds of cities and coming up with these values and then running them against a bunch of other cities to see if they actually made sense. And as far as I know, no one else contributed to this research. It was done over many, many years. So what you're getting here, I believe, is true value, because I'm not charging you anything for this system. There's no accelerator. There's no, but wait, if you do this, you will, you will get something better. Everything and anything that I could think of, I put into the system, and it is truly free. It is so free that you can give it away as long as you mention my name. Feel free to walk into a meetup and teach Neal Bawa's Real Focus system to anyone. You do not have to do anything more than attribute it to me. That's all you have to do But if you change it, if you improve it, I expect you to come back and let me know I made X improvement, Neal. That's all I ask so that I can continue to improve the system for other people. All right, let's go back to Real Focus 4. And Real Focus 4 says the following. If population's growing up and incomes are going up and house values are going up, usually what tends to happen, and vast majority of the time it happens, is crime starts to decline. Crime starts to go downwards in that city because crime is directly tied to low income and unemployment. And what's happening is that the city's lot is improving, and as it does, crime levels start to decline. So Real Focus 4 is about crime. And here's what it says. It says that you only want to invest in a city where two things are happening. Number one, crime is smoothly declining. So, well, that way, smoothly declining, right? Over a 15-year time frame. You don't want to see bumpy declines like Memphis, where you see it goes down, then goes back up, and then goes down, and goes back up. But the city's really fighting hard to reduce crime and locking up a bunch of people. You want to see a very smooth decline. And number two, you want to see a crime level of 500 or lower on the city data crime index. You want to see 500 or lower. There are cities in America that have astonishingly low crime, right? Absolutely mind-blowingly low crime. And then there are cities in America with astonishingly high crime, right? You can imagine some of those: St. Louis, Memphis, South Chicago, Oakland are cities with high crime. So is Baltimore. And then there's cities with incredibly low crime, right? So anyone care to make a guess on what the major city with lowest crime in America is? Major city being, a million-person metro, something like that. Any guesses? Come on, guys. You're supposed to be chatting with me. That is correct. Yep, Boise. So Boise, Idaho has the lowest crime of all of the major cities in America. So if you look at big major cities, Boise is very low. Tim Steele said Denver, and you are correct. Denver actually has very low crime, but it's not quite at the bottom, right? So it's in terms of lowest crime. There's a few others, but Denver is considered to be one of the low crime cities. The San Francisco Bay Area is low in crime if you remove Oakland. So if I take Oakland out, then the Bay Area is the lowest crime city in America. It's just slightly beats Boise, but of course that's unfair. So if I put Oakland back in, then it's somewhere in the middle, right? Now, where do you see this data? Where do you actually see the crime level data? Well, let me pop it up for you. And we're back to that page. We're back to that city data page. And now I'm going to scroll for a while. So it's not closed. You're going to keep going back. You're going to go past this little section here, and keep going, and there. So this chart shows the crime rates in the city of, let's say, Detroit by year. I'm going to switch over to Columbus. I'm going to go down and switch over to Columbus. There we go. See Columbus rates. Now, as you can see, there's lots of categories: the murders, the rapes, the robberies, the assaults, the burglaries. You're going to ignore all of these. All you care about at this point for the mathematics is the last row, the blue colored row. And what you care about is every single number in this row, though the most important number is on the far right. This number that I'm showing you on the screen right now, this number here, is 414.8. This is the number that Real Focus 5 says should be below 500. So you see this below 500 piece here? That's what I'm talking about. I'm talking about this number being below 500. And keep in mind, you can do this for a zip code. You can actually see if a particular zip code that your building is in is below 500. So that's a kind of a neighborhood tip, and we're doing it at the city levels, but you can, instead of typing in Columbus, Ohio, type in a zip code in Columbus, Ohio, or any other city in America. So this is the number that I want to see. But here's something much more important. I want to see a trend line. What I love about Columbus, one of the reasons why I mention it as a great inexpensive city, is look at how smooth the decline in crime is. 757, 717, 701, 686, 666, 621, 587, 561, 423, 414. Obviously, I skipped over some minor increases, but isn't that a very, very smooth decline over 15 straight years in crime, right? That's what I'm looking for. You want to go into cities that have that smooth decline because guess what is going to happen? Once you go into that city, if the crime continues to decline smoothly in that direction, it is going to have a direct and continuous impact on home prices. Which is going to have a direct and continuous impact on multifamily prices, right? Home prices, well, if homes double, it's not that multifamily is going to double, but your rents might double, right? Which is all you care about with multifamily. You're not really looking at valuations. You make your money on rent growth. And so rent growth might double. In the San Francisco Bay Area, it's common for, a three-bedroom home to have $4,000 to $5,000 in rents. Whereas in other areas like Columbus, the rents may be $800. Why? That's because home prices are much higher in the San Francisco Bay Area. So you're looking for home price increase, which is directly tied to crime decline. So as this crime number keeps going smoothly down, your home prices are going to keep rising. This doesn't matter as much when you're doing fix and flips. So the vast majority of my rules do make one assumption, that you're in it for longer than 2 years. Because if you're in it for less than 2 years, then it really doesn't matter at much. The quality of the area doesn't matter. What matters is your immediate gain. What matters is the value you created by rehabbing. So if you're a rehabber and a short-term rehabber, this is not as important for you. In my mind, though, the way to use it as a rehabber is completely different. As a rehabber, you use the system to decide which city you want to go into at the very beginning. Because obviously, your ability to generate money in Columbus is probably going to be higher than Dayton, Ohio, or Cincinnati, or Cleveland, right? Because the city is doing better. Even within the 2-year time frame, something could happen for the better and increase the profit. So you use this to decide that. And then you might go into fairly high crime areas in Columbus because you're not looking at that 10-year growth. You're just looking at your 12-month flip, right? So in that microcosm, maybe crime doesn't matter as much. But overall, I think it makes an incredible, incredible difference. So the next thing is Real Focus 5. And as you can imagine, Real Focus 5 at a city level is jobs. Employment is an incredible driver of profit for you. I see my students spending so much time on the property. Oh, I know everything about the foundation, and I know everything about the roof, and I know everything about the tenant. And what do you know about the area? What do you know about the immediate area? And so often the answers that I get are so incomplete that I basically say, there is an 800-pound gorilla standing right behind you, and you can't see that gorilla. And then you wonder why you buy in these different areas that have the same pro forma, and one property hits 20%, another one hits 10, another one hits 0, and then the last one hits minus 10. And you're like, but I had the same pro forma, but I had the same tenants, and the age of the homes was exactly the same. Well, that's because real estate profits are not driven by the property. They are driven by what's around it, both at a neighborhood level and at a city level. So I hope you're beginning to understand the value that comes in when you start looking at these numbers. And you can see astonishing difference in returns as you start moving in these directions. The cities that I am buying in, and I want to see if I can take a moment or two to actually show you some of my results, because saying all this stuff may not really matter, right? If the results are not actually there, right? Neal, I mean, you're saying all this stuff, but how has this really worked for you? Is this really beneficial? Well, I want to show you something that's going to knock your socks off. As you know, lots of the syndicators that are on this platform are all telling you they've had X returns, 20%, 30%, even 100%, right? And you're like, wow, these guys are superstars. Well, I have to tell you, honestly, we're not superstars. In the last 4 years, all ships rose. And as those ships rose, what happened was we were made to look like superstars. Everything we touched turned to gold. But that's not the case starting 2018. Now things are much, much harder. They're much harder because the market's gone up and all of the true value add stuff has already been done. So you kind of are, living in scraps at this point of time. So, but here's what I want to show you. The power of the system that I'm showing you, exactly that system was used to pick a property that we purchased less than 6 months ago. As you can see up on your screen is a property, Park Canyon. It is in a small city called Dalton, Georgia, and you're going to see this city shortly in about 5 or 10 minutes. You're going to see this city when I pull up job statistics, and you'll see, oh my God, this is a great place to invest in. And so I knew that because the city was not at the job numbers that Real Focus 5 talks about at that point. But you know what was happening? It was continuously accelerating. It was accelerating in every in Real Focus 1 and 2 and 3 and 4 and 5. It was accelerating in all of them. So I went out and bought this property in November 2018. And this property happens to be in Dalton, Georgia, which is actually not part of the Atlanta metro. It's part of the Chattanooga metro in Tennessee. It's just over the border on the Georgia side. And here's what's happened in this property. So we bought this property, and obviously our goal was to rehab it. You know, you've been listening about this all day, right? We want to rehab the property. So here is this property acquired in November 2018, and here is its income levels. And then here is its delinquency. Its delinquency has been $0 for 4 months, which includes January, right? Everybody knows that Jan is the hardest month to get rents because they've spent all their money in December. And why is its delinquency 0? Do I have the greatest tenants in America? No, they're just regular tenants. The reason is because nobody wants to leave. They're afraid that they cannot get an apartment anywhere else. And so they don't want to be delinquent and get kicked out of this property. This property continuously, every single month stays, and this is, by the way, the lowest occupancy. So far in June, we're at 98%. So if I go and randomly pick another month, I'm going to pick, the month of March, and I'm going to throw up that particular report. Here it comes. It's on your screen. And boom, 109,000 income, delinquency 0, occupancy 97%. And how the heck, obviously I did a good job of picking the property. I'm not suggesting that the system makes you can't go out and pick garbage. But the point is, I have not rehabbed one unit at this property so far because I don't even know where the bottom of the rents are. We've increased rents 6 consecutive months. The rents are up $120, but we haven't started the rehab. We haven't started the rehab at all. And that is what happens with quality of area. That is what happens when you start looking at areas. I want to give you another example. And once again, I'm not selling you on these projects because this project is clearly closed, right? You can't get in. But the point is that there are so many projects today in 2019 that are in the right places. And investors come and tell me, Neal, I think the party is over. And I tell them, no, let me show you 2019 results. So I'm going to pick another one. And this is one that was actually even newer than the other one. So I'm going to go investor updates, and I'm going to go final, and I'll just pick the most recent one. There we go. So this is in Tucson. I've been watching Tucson using the Real Focus system for the last year and a half, and this property is going so fast that we haven't actually managed to drop our occupancy. We've raised rents radically, like ridiculously, and you'll see exactly how much in this investor update, right? So we started June with lower occupancy. We raised rents like crazy and still ended up with occupancy higher because this area is on fire. It's absolutely on fire. In the Yardi Matrix May update, amongst smaller metros in the US, Tucson is #1 in the country. Keep in mind, there's 1,000 smaller metros. So it's very hard to even be in the damn list instead of being at #1. But Real Focus has showed it climbing month after month. 1, 2, 3, 4, 5, all showed it climbing. So we went and bought this property. And here's the ridiculous increases. Latest studios that were basically are at 575 in 4 months. We've only owned the property, actually 3.5 months. We were at 550 a month ago and 422 at the time of closing. These are basic turns, not rehabbed units. We're just cleaning them, and we've gone from 422 to 575. Why? Real Focus is. The area is incredibly hot. That's a $153 increase without doing anything. 2 beds, $231 increase without doing anything, just basic upgrades. This one, we are upgrading a little bit, but we're spending $2,500. Our budget per unit was $8,500. We're not even sure what to do with the rest of the money because it doesn't make sense at this point to spend that money when you get the bumps anyway. These are above our pro forma bumps. Here, latest one bed, $795 up from $621. That's $174 bumps. That is the power of the system that I'm talking about here today. And I'm not talking about past performance. This property, we didn't own it on the 1st of February this year. So anyone that's asking this question about, is this run over? The short answer is no, the cities are changing. It's a different set of cities. But there was nothing special about this property. It was on market. We paid market price. I didn't get a special price. I didn't get a sweetheart deal. There was no broker that loved me. I think we even paid $50,000 more because they simply demanded more money and we took it. My point is, it's the demographics that are driving the success, not some off-market random strategy where I'm getting stuff for 10% cheap, which, by the way, I don't believe in. Anybody who tells you they're buying properties at 10% off market are bullshitting you, right? That strategy doesn't exist today, not in 2019. You could get it in 2016, but not today. But you don't need it if you pick the right damn demographics. So back to Real Focus 5 jobs. But before you do that, I do want to plug shamelessly, absolutely shamelessly, some of my upcoming projects. So I do, unlike pretty much everyone that you listen to at MFIN, I do both new construction projects, because remember, how did I start in 2003, 2004? I built a campus from scratch for my company, and then I built another one 2 years later. So I have a real estate construction shops. So I'm doing opportunity zone projects. These are tax-free projects. They're 10 years in duration. I'm building a Phoenix downtown tower that's 250 feet high. It's about 348 units. It's a Class B. I don't like Class A construction. This one is a Class A because you can't really do a Class B in downtown San Jose. So it is a 54 unit multifamily, large units, and it is shockingly in the middle of Silicon Valley in an opportunity zone, tax-free zone. So if you're interested, if you have gains coming from the sale of a property, sale of a business, sale of stock, sale of bonds, anything that's long-term or short-term capital gains, and you don't want to pay taxes on those, talk with me about opportunity zone projects. Now, for the rest of you, well, let's just look at regular projects. So here is a non-opportunity zone project. Basically, this one is 1031 eligible, so you can take your 1031 funds and syndicate into it. This is a hotel that is 90 years old. Take a look at the hotel. 90 years old. Has been with my partner for 8 years, has been profitable for 8 years. It is on the Columbia River. You see the river here. Mount Hood is behind us. Gorgeous location, 100 feet high on a bluff, and you can see that bluff here with a private waterfall. The hotel is profitable. Its average daily nightly rental rate is over $200, even though Oregon gets very cold and they don't make any money in Jan and Feb. It still averages over $200 a night. It does over 100 weddings, most of them right here in this area. They do 100 weddings. What's their problem? They have a full F&B, food and beverage department, but only 40 rooms. So they can't optimize their profit with only 40 rooms. They are the #1 location for wine festivals in the entire state of Oregon, and it's only 1 hour from Portland. And this project, all we're doing is taking an existing hotel, and on the right here, so you see this little shrubbery here, actually, you see it better here. So you see these trees here? We're building a second building. We're adding a building. We're not adding food and beverage, but we are adding a conference center because there's been massive demand for Portland companies to come here and do stuff, but they want more than 40 rooms. They want to book the whole 120 room hotel. So I'm doing new construction here in this area. So that's a 5-year project, a regular 5-year project, 1031 eligible. And this is what the new building will look like. And as you can see, it's stunning, it's gorgeous. All 80 rooms, ceiling to floor glass. So basically one entire wall is glass. The top floor is a conference center, and every one of the 80 rooms directly overlooks the Columbia River. Gorgeous hotel, beautiful area, and I'm delighted to be able to offer this project after 3 years of fighting the city to get approval. And then my favorite project is not that one. My favorite project is one that you guys will like, multifamily. The fastest growing metro in America is St. George. It's been St. George for a long time. It's increased in size by 20% in just 7 years, not 16 or 17, but 7 years. Job growth, 4.4%. The national average is 1.8%. We are buying a piece of land there, which is very difficult to get. If you don't have Mormon connections, you cannot buy land in St. George. There's nothing available on the market. The land basically is connections that we have in the Mormon church. And so we've got a vertically integrated team where everything's in-house, construction, property management, basically partnering with me to do this project. What's truly awesome is this is 118 units, and the city does not like nightly rentals, but this land was grandfathered in. So they allowed us to have one building, 24 units, for Airbnb. And this particular address ranks 90 out of 100 on AirDNA. AirDNA is a website that ranks every area in the US in terms of its viability for Airbnb and nightly rentals, because you can make a lot more money on nightly rentals than apartments. Well, it's 90 out of 100. I own Airbnb rentals, and so does Anna Myers, my VP. We've never seen numbers higher than 70s. Higher than 70 is very difficult to get. This specific location is at 90. Why? You can see in the background, that is Zion National Park, and it has 3 million visitors every year. 3 million visitors every year. This project is, as you can imagine, for accredited investors only, 1031 eligible. I do have projects that are not for accredited investors. I cannot talk about them in this open media, but if you're interested, we can have that conversation as well. And the last thing I want to tell you about is that I teach a multifamily technology-driven bootcamp. That's roughly 1/10 of the price that you will pay in the marketplace. It's 10%. It is technology-driven and has 55 different technology tips, one of which you've seen today, right? So you obviously have seen the Real Focus system, but there's many more, and those tips are used to find properties, manage property managers, create virtual assistant teams, drive NOI up, do hundreds of things that no other syndicator could dream of doing simply because they don't have the resources or the tech. If you're interested, take a look at multifamilyu.com, multifamilyu.com for that. I'll walk you through multifamilyu.com, but I'm not going to mention the bootcamp again. And that bootcamp, as I mentioned, is 10% of what you would typically pay for. So if you're interested in syndications, you can type into the chat and let me know, or you can simply contact me. I'll give you my contact information. That's the end of my sales pitch. I'm going to go back to Real Focuses. So Real Focus 5 says that you want to focus on not long-term job growth, but 12-month job growth percentage. 12-month job growth percentage. And you want to invest in cities that are above 2% annualized job growth. If they're really big, 1.5 works. So like Los Angeles, 1.5 is fine, but you're probably not investing in Los Angeles anyway. 2% annualized job growth. And where do you find this data? Unfortunately, city data doesn't give you last 12 months job growth. It's always going to be many years behind. But our government sucks, horribly, horribly sucks in every way on numbers, except for one number that our government is awesome at. And that number, as you can imagine, is jobs. And why does it need updated job numbers? Well, because Social Security checks have to be cut every month. And so employment and unemployment status of everyone in the US is known in real time because the checks have to be cut in real time. So we do have access to that data more or less in real time. Where is it? In an oddly named website, the departmentofnumbers.com. So if you go to departmentofnumbers.com/employment/metros, you don't have to write this down. It's in the Excel spreadsheet. If I click on this link, it takes me to the real-time data for jobs in the United States. So here it is, departmentofnumbers.com, right? And you still see the Multifamily Investor Summit. It's following us around the web. Good job, Dan. So here, this page is incredibly powerful. And one of the things that I advise every one of you to do is every month, I want you to go in here on the first of the month and go to the bottom, right? Go to the absolute bottom. As you can see, every city in the US is represented. And then copy paste it like this and here. And then paste it into an Excel spreadsheet and name that tab This is April 2019. So call that tab April 2019. I want you to look at this every single month, right? Why? Because you're looking for trends. It's not as hard as reading tea leaves, but what you're not trying to do is to look at areas that are only in here for a month. Why is that? Well, that's because Amazon could have opened a distribution center in that place last month and hired 200 people last month. And so the city goes to the top of the list. Well, that's not enough. You want to have the city be in the top 2% of this list all the time, every single month. You want to see that consistency, and that will give you magical profit. Why? Because here's what Real Focus 5 says. 2%, good. 3%, you're overjoyed. It's so much easier to hit double your money in 5 years returns in a city that has 3% job growth. At 4%, you're ordering cases of expensive champagne. And at 5%, you're doing the naked dance on the street. I do the naked dance on the weekends just so that I don't get arrested. But you'll see that cities that I've invested in over the time, they're not always at 5%. 5% is very tough. But you'll see that cities that I've invested in are very close to 5%. So how do we find, what number are we looking at? Because there's a whole bunch of numbers on here, right? What is the important number? Well, it's the last column. So you see this number, CES, 1-year job percentage change. I'm going to click it, and instantly these are the worst cities in America to invest in. Why? Because they have negative job growth. During a time of 3.8% national unemployment, during a time when we create 200,000 jobs in this country every single month, how could we possibly have job loss? Well, that's because these cities are all losing population. For God's sake, do not put your money or an investor's money in any one of these cities until you hit zero. Once you hit zero, you're okay. I don't recommend that you invest in cities that hit 2. But when you're investing in cities with negative job growth, that is not speculation. That is a death wish. And what's sad is that I very often see these being offered by turnkey providers. I love to bash turnkey providers because no turnkey provider should ever be offering properties in a market that has negative job growth. Negative population for a year or 2 is acceptable, but negative job growth kills rent growth, and it also kills your occupancy. So never, never, never invest in these places until they get to be positive for a number of years. Now let's go to the real number. When I click this button again, these are the most powerful places in America to invest in. And as you can see, my favorite, St. George, Utah, stays at the very top of this list over and over and over again. So does Boise, a city that I love and I talk about very often. It's the lowest crime city in America. So is Kennewick, Washington. This is a city in the Tri-Cities area of Washington. It shows up in the list constantly. I have 2 or 3 projects that I'm trying to run in Kennewick, Washington, including building a downtown hotel for the city of Kennewick, Washington. So I'm working on that. Cape Corals and Fort Myers are part of my corridor of opportunity. And this is a very good time to show you the corridor of opportunity. So if you go to Google and you type in corridor of opportunity, Neal Bawa, and right there, right here, you're going to see the corridor of opportunity. When you click on it, this is a fascinating story that tells you about what I believe is the greatest single corridor of opportunity in America. It is in Florida. It is not in any sort of city that you really think about as powerful, but it is an incredible corridor. And when I initially published this a year ago, the corridor started in the city of Deltona above Orlando and finished in the city of Bradenton below Tampa. Okay, and it passed through a city called Lakeland, so keep that one in mind. But now the corridor is extending. So far, it's not extending up, it's extending down, and it's actually becoming a web. So it's actually, this Lakeland, it's projecting outwards in both directions. So now the new corridor of opportunity still starts at Deltona, runs through Orlando, through the city of Lakeland, then Tampa, turns south, hits Bradenton, goes past Bradenton to Sarasota, then turns south again, hitting and ending with the twin cities of Fort Myers and Cape Coral, which are right here with incredible job growth. Right here, Cape Coral, Fort Myers. Every city in the corridor of opportunity is going to show up above 2%. Most of them will show up above 3%. Everything in that list. And now it's becoming a web. You will start seeing cities like The Villages. The Villages is a very small city, but it happens to be on the ultra small city side, even faster growing than St. George. And then you'll see Sebring, which is south of Lakeland and shows up in Housing Alerts list at a 96 out of 100 rating, which is a very, very difficult rating to get. It shows up in that list. This corridor of opportunity is tied back to this job growth. Very, very powerful. This corridor of opportunity is something that everyone should be looking at. Obviously, Orlando's expensive. It's very difficult to get anything, but Lakeland's still cheap. So is Sarasota, or parts of Sarasota, and so are parts of Fort Myers and Cape Coral. For those of you that like to construct, Fort Myers and Cape Coral also have some of the best opportunity zones in America, ranked over 90 out of 100. Sarasota has one that's 97 out of 100. Why? Everything's going insane in this area. This area, in general, not every part of it, but most parts of it, are in that naked dancing level. That's when you make crazy money in real estate. And you do it by keeping an eye on this list. My second favorite city after St. George, Utah, also happens to be in Utah, and it is Provo, Utah. Provo has been in this list forever. Those of you that know me know that this is my third year talking about Provo. Third year. In my real estate trends presentation, which is on our website, I rank Provo #1 in the US for 2017, though Boise beat it in 2018 and 2019, just barely. I've been going to Utah for years and looking for property there. But the problem in Utah is related to the good part of Utah. The good part of Utah and the bad part of Utah are both tied to Mormonism. So, as you know, Mormons produce a very large number of babies, right? Which is great for real estate investment because Utah has one of the highest population growth rates. I have 6 partners in Utah. Average number of kids, 5. 5 kids average, 6 different partners. And that, though it's funny, and a lot of you are laughing on the chat, think about it though. It's not that funny. Large population increases correlate to profits for you. So if you're investing in a 10-year time frame, wouldn't you want to invest in a place that doesn't use contraception? It's important to think about that. Usually though, that's, those places are tied to low growth, but Utah is the second fastest growing state in America. Second fastest growing state. And frequently Provo, if you Google Provo, Utah fastest growing, you'll see that it shows up as #1 or #5 on a whole bunch of different lists, Realtor.com, Zillow.com. It shows up on those lists all the time. Now, I tried to buy in Provo and failed spectacularly because I wasn't part of the Mormon Church network, and most transactions there basically happen inside the Mormon Church. The Mormon Church is the richest church in America, and almost all of their assets are held as real estate, land, and property. So they buy everything in the marketplace, so there's nothing to sell, and there's a massive amount of scarcity. So after a year and a half of banging my head against the wall, I did what most syndicators I tell them not to do. I just built this from scratch. 102 units, all of them with the same unit mix, 3-bed, 2-bath. Keep in mind in Provo, because everyone has lots of kids, you don't do studios, you don't do 1-bed, you don't do 2-bed. Everything is 3-bed, 2-bath. And Art City Center, the apartments have been at 100% occupancy since I built it. This is in Springville, 5 minutes from Provo. And the cost of construction in Utah is so low that with granite countertops and steel appliances and lots of amenities in a secure building with elevators, I was still able to build at $135 per square foot. More like $125 a square foot, with large floor plans, 3-bed, 2-bath floor plans, and all kinds of amenities, and a secure building that is locked. So all of that is doable in a place like Art City Center, and people are fighting over these apartments. I have 0 vacancy. Why? Because Provo has the trifecta. Of every city in this long list, there's only one that has the trifecta. It has tech. Google Fiber is free for everybody living in the city. It has education. BYU and UVU are incredibly powerful universities with a very high quality, low cost get graduate. And then the third part, which most people don't think, but it's the most important, it has world-class skiing 20 minutes away. And people that come to Provo get addicted to the skiing lifestyle and never leave. And that's why that city is at this absurd number all the time. No city should be above 3% job growth continuously, but if you look at Provo, it's at 3.65. It fluctuates between 3.65 and 5, but never really drops below 3.5%. It's just constantly there. And that's why I invest in Utah, because their Mormon church buys everything in sight. There's nothing, no real estate available, no land available. But look at these numbers. Look at St. George. It's constantly at the top of this list, right? It'll never even come down to like beyond 10. It's just there all the freaking time. And that's the power of demographics. Here's, for those of you that are Airbnb people, here's a really good one. It stays in the list. Coeur d'Alene, Idaho. Not part of Idaho's economy. It's part of Washington's economy because the city of Spokane, Washington, is 20 minutes away. Coeur d'Alene is a resort. It's a very beautiful part of Idaho. Does snow there in the winter for a couple months, but the rest of the time would be an incredible buy for those of you that are interested in Airbnb. And look at that job growth rate, 3.5%. And then you start seeing the other cities in the corridor of opportunity. You're going to see Orlando, you're going to see Tampa, you're going to see Sarasota. They're all going to come in the top, at the top of the list as you scroll down through the list. Incredible power. Look at Phoenix. Look at Lakeland, Florida, which is in the center of the corridor of opportunity. How do you lose money in these kinds of places? What is amazing is, of the 61 people that are watching this, did one person know what I told you? Not one of you knows. Every investor overrates their ability to be data-driven. The truth is, you're not data-driven. You're not. That's the truth. This is what you should be doing in real estate. This is what you should be looking at. This is what your investors are actually paying you to do. And when you do that, yes, in 2019, you can double their money. Absolutely can. Now, what I've given you so far is a tiny microcosm of the research that I do. What I do is every time I research something, I put it into a toolkit. And the toolkit is massive and it keeps getting bigger. I put it on my website. It's free. You know, I like giving stuff away for free. So here's a toolkit. And then you can see that it has my trends presentation, which has a lot of multifamily specific information, trends, best cities to invest in this presentation. Then it has a whole bunch of videos, and we change the videos out every month. So we put in new videos that are important. Then it has a bunch of articles, with the most important article being this one. If you want to sell investors on multifamily, you have to use charts from here. Future Homeownership, Myers and Lee, is one of the most compelling documents. If you truly understand how to pitch this to investors, is the most compelling document I have ever found. And it is part of all of my presentations to investors. Reports, rankings, trends, all kinds of trends, senior housing, student housing, industrial, all kinds of trends. And then all of our webinars, not just my webinars, but webinars from a whole bunch of speakers that are data-driven people. This guy teaches you how to get better loans. This guy teaches you how to rank neighborhoods. This guy teaches you how to do due diligence. And this woman is incredible at underwriting tips. There's over 50 presenters, all on multifamilyu.com, over 50 of them every year, with over a dozen of them being presentations from lawyers about structuring, taxes, and profits. So you can see, we just did one last week for opportunity zones. We're doing one for effective multifamily financing. We continue to do these webinars. They're all free. No one ever pays for any of these. And you can see just how many presenters there are. So keep coming to this site. How do you get access to the toolkit though, right? This entire toolkit, and most importantly, the two files that I've been using throughout this presentation. You see this city and neighborhood comparison worksheet and real focus cheat sheet for cities and neighborhood. Both of those are in section 7 of the toolkit. How do you get the toolkit? Take your phone out. Grab your phone, take it out, and let me scroll past this. send a text to the number 44222. Send a text to this number, 44222. The text message should be just one word, RE Toolkit. And be careful that your phone doesn't add a space, because if it adds a space, you'll get an error message. If it adds a space, just remove the one space. This is the number. This is the one-word text, RE Toolkit. When you do that, you'll get access to this page. You'll get an email in about an hour, and it'll give you all of the sections here and all of the resources, including cap rate surveys and the top resources for city-by-city multifamily trends. Every city's report, 4-5-page report on every city in the US, its cap rates, its demand, its supply, its population growth, all of that is in this 9th section. And you get all of those, and they're updated every quarter. Send a text message, 44222, and text the word RE Toolkit. Perfect. So the last thing I want to end with is, everything I just gave you allowed you to become a fantastic investor. A lot of people think, Neal, this stuff is free, therefore it has low value. I beg you not to think that. 5 years of my life have gone into building this system. I didn't at any point think that the value was low. I just want everyone to be able to make good decisions, so I give it away for free. The challenge is, in an hour and 15 minutes, I only taught you half of it, one half. The only way for me to teach the other half was to do a 2.5-hour presentation. And I did it already, and it's also free. It's at udemy.com. Notice what I'm typing, udemy.com/realfocus. udemy.com/realfocus. The second part of the presentation is the neighborhoods. And I'm going to go through 5 real focuses, because you picked the right city. Maybe you picked Provo, maybe you picked St. George. Hopefully you picked Utah. And now St. George has bad neighborhoods. Provo has bad neighborhoods too. How do you figure out the right neighborhood to buy in, right? Because great cities all have awful neighborhoods. Well, the same way that I taught you for the last hour, there is a 75-minute presentation here. Skip the cities portion, you already learned it, and go directly to the 5 neighborhood rules. And the Udemy site will then, basically at the end of that time, you'll be able to pinpoint every high quality neighborhood in America. It's also step-by-step. It also uses the city data website. But in my mind, it's much more powerful, because you can very easily buy a horrible property in a great city. So make sure you do that at udemy.com/realfocus. You'll notice there's no sales pitch. There's no upsell. We don't have any. The only thing I ask you is this. If you like my course, give me a 5-star review on udemy.com. And that is the end of my presentation.
Awesome. Thank you so much, Neal. I appreciate that. There's a lot of great comments already coming through about your presentation. It always has good rave reviews. And I went ahead and typed into the chat box there so everybody has it, the RE Toolkit, all one word, and texting that to 44222, as well as the website there for the udemy.com and the Real Focus. So people can easily click on
Let's also do multifamilyu.com, because that's
Sure.
where my webinars are. So let me type that one in, multifamilyu.com. And remember, the corridor of opportunity, the best way to look at it is corridor of opportunity space Neal Bawa. So if you do that, Google will basically pull it up for you. But I encourage those of you that don't want to go look at Utah, you might want to look at Florida. Florida is set for a 20-year run. Keep in mind that on a per capita basis, no state in the US attracts as many people as Florida. And no, they're not just old people anymore. They're diverse. People that are 17 or 18 are going to Florida, not just people that are 60. I think you would miss a golden opportunity over the next 2 decades if you don't do that. If you don't want to listen to me, listen to Bruce Norris. He's California's celebrity forecaster. He's been right in every recession. He just sold everything he had in California, even though he lives here, and moved all of his money to Florida. And by the way, the place he invested in is a city called The Villages.
Yeah, I have a good friend of mine who has a medical office there in the Villages, and it's definitely one of his top clinics that he has. So I do have 2 quick questions here. I know we only have a few minutes here before we wrap this up. The first question was from Chad saying, and you might have already answered it. I'm not really sure. Did you go through any of the questions that were coming through at all, Neal?
Not quite. Let's go through them again.
Yeah, there's two of them real in here right now. One of them is as the years go by, do you ratchet up the year 2000 by 1 year and adjust the 2016 years by 1 year as well to keep them the same data history range?
You do ratchet it up, and the rule is in that Word document. You don't change the baseline. The baseline remains 2000. Okay, but you do ratchet up the numbers for every single year, and the amount that you have to ratchet up is in that doc. I just didn't focus on it because I didn't have the time, but it's there. Remember, once you do the texting and you go to my website to that section 7 to grab the Excel file and the Word doc, all the ratcheting up is provided.
Awesome. Thank you so much for that. And last question here is if a city is close to your minimum standards, but not quite, do you pass on it or might you still consider it as an investment area?
I absolutely consider it. These are, so I call them real focuses. I don't call them rules. They are rules of thumb. And I think that there are a number of reasons why you might make that exception. Number one is the recent performance of the city has been better than the past, so which is why it's not hitting those benchmarks. Number two, you have a great team in that area. You have either a great property manager, a great rehabber, somebody who you know and trust, yes. But don't go too far below, right? So in my mind, on the population growth, instead of 20, you can go to 12. But if you drop it and say I'm going to go to 0, then you're basically you're turning data into speculation. Yes, drop any one of these statistics 30 or 40%. Don't drop all of them by 30 or 40%.
Yeah, good point there. Well, Neal, I want to thank you so much for coming here and spending some time with us and sharing your presentation. I always enjoy listening to it, and I know a lot of people even on here said they'd heard it once before, but they always learn something new because you always are keeping things fresh and changing it, and your energy is always so addicting as well. So thank you so much for being with us here again for the second Multifamily Investor Nation Summit.
Thank you. I'm so glad to be here. And honestly, the work that you're doing in putting these summits together is incredible. I mean, I love the energy from the attendees, but I have to say I've made more connections on the presenter side than I've made even on the student side. And those connections have been wonderful. I've had a chance to meet those people in person since, the first summit was conducted. I think I've met about a dozen of them. And so some amazing relationships are being created thanks to you, Dan. Keep doing it. It's wonderful.
Well, thank you so much, Neal. I hope you have a good rest of your day.
Thank you. Bye-bye.
All right. Thank you again, Neal.